All right, here we go. Okay, thanks for joining everyone. So I'll focus on the journey about capital raising and try to share some of my insight. They're not the Bible. They just reflect my personal journey. Um, so why the swamp analogy? In a swamp, there's lots of diverse creatures, and in the capital raising world, there's also lots of diverse creatures, and we'll go through some of them. A swamp is an ecosystem of its own, and that's the same about the capital the capital world. It's different from our usual ecosystem, if you want. And a swamp can be difficult to navigate with lots of potential traps, quicksand where you get stuck or dead ends. So let's first have a look at the creatures of our capital world. Well, there's different types of investors. There's the friends, family, and people usually say fools. I like to say fans. This can be people that believe in you usually and will provide the initial funding. Then you got angel investors who are kind of a pool of normally formerly successful entrepreneurs or people who are interested in the field you're working in and will pull their money together and invest. Then there's the crowdfunding, which is all those crowdfunding platform that you have now. And there are some which you can fund a concert, whatever, not-for-profit cause, but you can also, there are some specialized platform that now fund companies. There are family offices and high net worth individual. There are people in this world got a lot of money and they don't mind investing it in more risky ventures than just the normal stock exchange. There are venture capitalists which specialize in investing in high risk companies. And then there are private equity. And there's a speaker afterwards that will take you through that specific part of investment. And there's also non-dilutive funding organization, basically grants. The government is giving a lot of money through starting companies. So as you can see, already a lot of different players with different ways of investing and different expectation. So, and there are pros and cons for all those different investors. Family and friends will invest out of love and friendships. They sometimes can have unrealistic expectation, and it's difficult to get rid of them if they're on your board. Everybody knows it's difficult to sometimes manage something with family. So that's the con. Angel investors and accelerators will invest in ideas, and they usually have a good network that can help you raise future funding. They usually will not invest a big sum of money. I mean, here in Australia, typically invest less than $500,000. In the US, a bit more. Family offices and high net worth individuals do invest in business on the medium and long term. They tend to invest in the business. They tend to want to build a business, which is the positive. Sometimes they have absolutely no knowledge of the industry. And there's also in family offices some family dynamics sometimes. So this can be difficult to handle. Crowdfunding platform, readily accessible, and there's now structure and product firm that exists to fund a wide range, usually more tailored to B2C rather than B2B. And you will have to deal with a lot of shareholders. So it's a little bit like doing an IPO without doing an IPO. So you need very good governance and you need to communicate well. Venture capital funds, there's lots of them. They're very specialized. They can sometimes invest in successive rounds, and they can also bring larger players like private equity funds. Their modus operandi is very simple. They typically invest in 20 companies and hope that one will become a very successful one. And so they don't mind killing your business if it doesn't work. Private equity funds are powerful with a lot of resources and are interested in growing the business and not for a quick buck, but typically only look with established business and very rarely startups. The only exception that I personally know is Moderna, who came up with the mRNA and was a precursor of the COVID vaccine. And last but not least, non-dilutive funding grants. So the great thing about grants is you don't have to give up equity, but it's slow. It's always tedious. Your grants application, you have to put a lot of effort in it, and sometimes can be distracting. So now we'll move from the players, those different investors, to the actual ecosystem. So there's lots of players in this investment world, lots of people you need to talk to, or you can talk to. There are, of course, government investment agency that supports new startups or companies or small SMEs. There are investors. There are people that run databases. You might have heard of PitchBook that will provide you against a nice fee, maybe 15,000 US dollars, a database of investors all around the world with some investment data. It can be very useful, but it's expensive. You got lawyers that can help you with contract, but they also have connection usually with investors or people that players in that world. Patent attorney can also be a source of connections. You obviously have capital raising firms that can help you find investors, usually for a success fee. It used to be only a success fee. Now it's a success fee and a retainer. You've got university accelerators or state accelerators where you can go and you will be in an ecosystem with other startups, and you will have professionals, former entrepreneurs that can help you raise capital. Then you got valuation firms, which are the people that will calculate what is your opportunity worth, what is your company worth, and therefore, you know that if my company is worth 20 million and I want to raise 10 million, then I have to give 50% equity. Okay, so now let's see what's the roadmap, how we can navigate the journey. Again, this is my own vision. Everybody's got its secret roadmap or secret recipe of how to do things. I would start with a plan. It's always good to have a plan. So in the plan, there should be what you need the money for, how much do you need? And it's better to start with what you need the money for and then cost it rather than saying, I want this, and then limit yourself to that if you need. How fast do you need it? How much equity are you prepared to give away to investors? A rough budget, a rough valuation. So I have an idea of what you think your opportunity is. Identify which is the more likely option for you to raise. So depending on the stage of your company, you think it's going to be angel investors, you think it's going to be VC or private equity. Identify the resources that you will need in the ecosystem. So there are things maybe in-house you don't have. So that's also important. So once you've got this rough plan, the next stage to write an information memorandum, which is basically an investment business plan where you put the investment case. So the first and most important thing is to put yourself in the investor's shoes. Why should somebody invest in my business? What are they going to get out of it? And why should they give me that big amount of money? It has to be detailed proportionally to your raise. So if you raise 100,000, it can be relatively succinct. If you want to raise 10 million, it has to be extensive. And you have to be able to defend everything. And the main thing is don't lie, don't make it up. People will catch you because investors will come in and do a deep dive in your data room, and they will turn every stone and ask you questions. Then you need to have a powerful slide deck. Okay. So I typically use a teaser and then a full slide deck. So I send teaser to people, especially in the US, which is typically structures why you need the money, why invest in your company, and why invest in you personally. You as the founders team, Can you execute on your plan? Do you have the knowledge? Do you have the experience, etc.? And last, but very importantly, why now? Why should people invest now and not in 2 years in your idea? And then you got a full slide deck where you talk about the problem you're trying to solve, your solution, and why it's unique, and budget, intellectual property, milestone, valuation, and very important, don't forget it, exit strategy. How are the investors going to get their money back? And then you build up an investor list, you ask your network for contacts, use database, get referral. That's the best. If you can get people to refer you to some investors, that's the best way. Participate to partnering event, which is what I call investor speed dating. Consider using capital raising firm, but beware of high retainer fees and build up a consequence list. You need a lot of name and then you go through them because the ratio might be 1 to 100. So you need to have a lot of names and you need to have a big list. And the whole game is you have to kiss a lot of frogs before finding Prince Charming. So that's why you need that big list. You need to know what you prepare to sacrifice. So, are you prepared to sacrifice a lot of equity? How many board seats are you prepared to offer to people? Because those people want to, put their money in, they want to sit on the board, they want to have some decision power. You have to stick to your gun and plan. So people always remind me beggars can't be choosers, but still, if you don't think an investor is a good match for you, if it doesn't suit your level of development, your business or your strategical need, you're better off maybe passing that opportunity because you're gonna pay for it down. You also need to think like an investor when preparing your information memorandum. They want to make money. They're investing in you because they believe in you, maybe, but also because they want to make money. So the big question is, what is going to make your business attractive to an investor? Make sure the personality match, especially for people wanting board seats. So, the test is, would you fly with that people next to you from New York to Sydney? If you don't think so, just beware because you will see a lot of them and you will have discussion and you will have arguments with them on where to take the business. So if you can, try to find somebody you get along with. Be aware of macroeconomic conditions. So I've tried to raise capital at the beginning of this year and end of last year, and it was like preaching in the desert. Nobody wanted to put any money on nothing, and it's not only in my business, it was in any business. And that's because there was high interest rates and no capital risk. So in conclusion, the main thing is to try to enjoy the journey and not to worry too much. It's very stressful, but don't worry, you will get there. Perseverance will take you there. So a few final disclaimers. These are my personal views and not encapsulations. These statements are generalities and there are always exceptions to every rule. There are no magic recipe to capital raising. Otherwise, we'll all be rich and famous and that wouldn't be a problem. And one personal note to Mark Richardson, don't get upset because I compared you to a water buffalo. Okay, that's it for me.